Everybody, hi, it's Mike and Joe. We're going to talk fun stuff about the market. We haven't done these as frequently as we should, so first off, we apologize. We have more shows coming out, I promise you, more market analysis, good stuff. But let's talk about real quick, Joe. Are you there, Joe?
Yeah, I'm ready to talk about. Sorry.
Let's have fun, man. We were just talking and we're like, you know what? Let's do this real quick. And so it's kind of this is impromptu. I know there's a lot of podcasts where they have listed questions, they talk about stuff and they're like, oh my goodness. But I think you and I talk about so much stuff in the morning. I figured let's just be candid this morning.
Let's
Let's
just hit the
record some.
record button. Yeah,
Yeah, I'm
yeah,
like, dude,
right.
I
Might as
sent you the
well.
link. I'm like, bro, let's just go on camera. Are you proper? Are you dressed? Did you comb your hair? Your haircut looks good, by the way.
Thanks,
Um,
bro. Thanks for
I did.
noticing, man.
Yeah, thanks, man. I did mine, but like, look, dude, like it's very easy. It takes 2 seconds. My barber is one of my best friends. Is called me, Mike. He's great. He's just incredible.
I hope you tip well, man. You deserve that.
yeah, that goes to my wife.
Oh man,
All
I feel
right,
that.
dude. So headlines. Everybody is losing their crap all of a sudden nonstop, and it seems like we have a dramatic slowdown in the market. However, I think, and I was on a podcast last week for somebody else back east, and for a nationally syndicated show, and not to say it's all
Ooh,
cool, but
ooh.
ooh, no idea how I did that. And afterwards, we had a chance to talk and pray a little bit. And it was funny because he was going through, he's like, man, my investments, my portfolio, the real estate properties that he has, he does a lot of private money. Defaults are starting to pick up. And then everybody asks us, like, this is going to be a crash. And, um, Zillow came out with a report, and I'm going to pull up that real quick. And it was basically Zillow is saying it's a slowdown, and we're starting to see home prices coming down in certain markets. But here's an article. Actually, no, this is 2025. Sorry, but the idea here is like we're starting to see in some people. We're starting to see. Here's an article right here. I'm gonna share it real quick if I could share my screen. And so this shows slow competition among buyers flattens out home value appreciation. This is from February, right? So February 2025. This came through, and another concern that we're running into here is we're seeing. Sorry, I'll close that out. Basically, we're starting to see, of course, in a month or so before that, or during February, saw interest rates drop. We're all happy. And, it's funny, we're going to February, March, and then rates went back up. And then, of course, in April, they came back down a little bit. A lot of chaos, and we're starting to see home values come down. But the interesting thing about home values is people are kind of freaking out saying, okay, this is a 1% to 2% drop. And what people are not really understanding is even with a drop in real estate prices, it's 1% to 2%. And the reason why I want to share this, and maybe we could talk about this, what we're seeing with our clients, Joe, if that's okay.
Yeah.
And then, maybe you could shed some light on things that you're hearing and folks that you're speaking with is even though it's slower, it's 1% to 2%. If we look at bigger numbers and we look at we start to see things like the 2008 Great Recession, right? That was a very different market, and the reason why is we had home building up at a high. The demand was not as great, the supply was lower, and we saw basically home values basically spike and then come down real quick because of course greed, Graham-Lee-Spliley, the deregulation of housing and mortgage markets, the banking system that we had through Graham-Lee-Spliley. And that was really due to the administration before George W. But and not to say political party versus one versus another, but that was at the time in '98 known as a great achievement. But yet it kind of landed a lot of us flat on our face because greed took over, unfortunately, right? And then you had that with essentially the banks deregulation, pushing for higher values, everything dropped. Now what happened now? A little bit different. We saw regulation. Dodd-Frank came with the Obama administration. So that was basically regulating what we do, where we have to qualify clients. And Joe and I just had a client who is a really well-known CPA throughout California and has his own accounting firm. And his deal wasn't the easiest because of documentation. They over document and over regulate everything still. And when you're in a tight money market like this one, you're starting to see more of that. So if they're saying home values are going to drop 1 to 2%, it's not 50%. You're not going to see a property that appreciated 15 to 20% year over year come down like by 50 to 60% of its peak. You're not going to see that $1 million property drop down to 400K or 500K as we did in 2008, 2009. I think that's another thing to recognize. And there's still limited supply with the increased demand. So 1 to 2% in some markets, remember that's nationwide versus what we're seeing is one huge thing. We're still seeing people apply. We're still seeing multiple offers. Joe, you're seeing that. Can you shed some light on what we've seen with some of the pre-approvals that we gone out? Have we seen success there? And kind of what are your thoughts?
Yeah, no, I mean, I think it's slowed down a little bit on the pre-approval front. We do still have some people submitting offers. And I mean, you could probably speak to it more in regards to like the competition that they're seeing on offers, right?
Yeah,
But I think what we've been finding success is with our clients who have basically taking advantage of our TBD underwrite process where we get them fully underwritten.
yeah,
That way, when they do submit their offer, they can go non-contingent. So that way, anybody else that they're up against, they have that competitive advantage of being able to say, I've had my file already underwritten. I can go with a shortened timeline for my closing, or I can even, take that step further and go with no contingencies. That's always a big selling point for
yeah,
sellers, right?
yeah,
So,
100%. 100%. And I think the big thing is, people are, griping about rates, but I mean, relative concern here is interest rates and where they are. And I get it,
mhm.
100%. But let's be realistic. If we look at interest rates over the span of the last 40 years, the average is 6 to 7%. Where are rates right now, Joe?
Yeah, they're about that 67%.
We have peaks and valleys. Nothing moves in a straight line. But I remember we went on a little week trip during spring break, and I'm like, "Hey, Joe, man the fort for me, brother." And you're a blessing, man. I can't thank you enough for
Oh, of
everything that you
course,
do
man.
for me and Jacqueline. Of course, my wife always is just like, "How's Joe?" And she loves you, and just thank you. And our daughters as well adore you and your family. But
Of
that
course.
said, um, I went on this trip and it was, the first week of April. And I remember it started with our church did something called Beast Feast where we cooked like 800 pounds of tri-tip. And we had someone that was a former Army Ranger speaking to our church and kind of, yeah, really it's this idea that, Beast Feast is a great thing where we share and kind of stories of those that had served in trivial areas of life and of course in combat. And we eat a ton of steak and have a good time. If you're a vegetarian or vegan, I apologize in advance.
Hmm.
Of course, there's my disclaimer. But man, it was fun. I was out there cooking for 10 hours, and my wrist got sore just from flipping 5 pounds of tri-tip all day. Just big old things. Anyhow, what's funny about that is, that morning I remember looking at the treasuries and I always check futures. I always check them the night before and I text Joe and Joe, you're on the opposite coast. And I reached out, around 8 a.m. your time, 5 a.m. my time. And I was watching
Yep.
futures. Oh my gosh, we could see things drop back down. Let's get folks ready again. Because we did this with 17 transactions. And I was on another podcast, not to say I'm all that, but someone asked me how we did it. And it was just admitting our failure. And September and August when rates did drop and they kind of fell down that area. Then, of course, October, they spiked back up with jobs numbers that came out over the weekend about a month prior to the election. And, we're anticipating this. And as that happened, I was like, Joe, well, let's be on target. I'm going here. I still have to serve. I mean, I committed to it. It's me and my buddy Mike really cooking with a couple other buddies, but we're there all day. People come and go. So, we got to get this, 800 pounds of steak ready for 5 p.m. So
Ooh.
I was there all day and, watching the bond market, things seemed to turn pretty good. You come into Monday morning and we went to Ventura. This is the thing on a spring break trip. And then literally things futures spiked over the weekend because of concerns of really it was all headlines. And
Yeah.
then I said Sunday night, we're at 4.5, but then something happened where from 4.5 on the 10-year treasury down to 3.86 literally within an hour. I reached out to you again Sunday night. I'm like, hey man, just so you know, I'm gonna be watching this closely. Let's get folks ready. And then of course everything is hindsight where the markets the interest rates, and I'll explain this. Interest rates for mortgages are essentially bonds. It's mortgage-backed security. So if you follow the bond market, a long-term asset like a bond, right, or a 10-year treasury, that is what rates tend to follow. And so if you're seeing the bond market, and we're always saying, can we get below 4? That's what we've been saying for last year. If the 10-year treasury hits below 4%, we'll definitely see improved interest rates.
Yeah.
It never got there. And it long enough for interest rates to shift, if you will. Yeah, it got there for a quick second, but the interest rates didn't shift. And that's what we need. That's what we're waiting for. That said, we're not hitting 5.5, 6%. We did 17 transactions where we had a strike rate set up in late February, and it blessed a lot of our past clients. We did this as no point, no cost refinance, right? And we helped out quite a few of our clients, and it was because we missed that in September, October. I was on that
Mhm.
podcast sharing like that was a missed opportunity, but here we are, and we're like, dude, here we are. And then everybody sees 6%, 7%. They're concerned about the current administration. And again, not political, but people are starting to say, what the heck are we going to do? We're fearing a recession. We're concerned about these items. And then we're concerned about, oh, well, we're not going to buy because home values are going to drop because that headline came out again by Zillow saying it's going to drop 1 to 2%. And just to bring it all back, I know there's been some bunny trails here, but if we say it's 1 to 2%, that's not a big drop. That's level. And what people don't understand is in most recessions, and I can pull this graph up here in a second, but in most recessions, home values continue to appreciate or they level out. But also what happens is interest rates come down. So
Mhm.
if you're on the sidelines and step out like, dude, I don't want to wait. I'm going to wait for interest rates to improve. Well, you're doing yourself a disservice because if you do, so is a lot of other folks. I'm concerned about recession. Well, long-term asset like real estate, bonds, something that's not as not as volatile as your market indices. Real estate's a better asset. It's a more long-term asset. And so I think a lot of people are stepping out. I think we've had a few of those folks, Joe, this year where they
Yeah.
started to come in like, you know what? I'm just going to wait. I'm good.
Right.
We're going to hold off, right? So kind of we've seen some of that, 1 to 2 offers on a property versus our 10 to 15. And then the last thing I'll share is we're starting to see more values or more properties, should I say, hit the market. So we have
Yeah.
50% more properties on the market than what we had last year.
Yeah. No, that's kind of just a crazy stat right there.
Yeah, man. I mean, it's incredible, right? So we're starting to see a lot of this right now, man. Kind of what are you hearing from buyers? What are kind of the number one complaints you're hearing or kind of risks and kind of what are you hearing as well, man? I mean, I know we work together, but I mean,
Yeah.
we're obviously in two sectors, obviously, front of house, back of house. So kind of what are you hearing? What are you seeing? And yeah, what's kind of your scope of things?
Yeah, as normal rates, that's the number one thing, but obviously I have a great partner like you who's always able to speak to clients about that and, really get clients not, excited,
Yeah,
sometimes they might not be quite where they thought they were going to be, but when they have that breakdown from you, it really puts into perspective the
right,
rate that they're basically getting. So,
right.
the second thing, and it's just this underwriting process that, you had mentioned earlier on, the client that is a CPA, a prominent CPA in California,
Yeah,
where by all means, slam dunk transaction, very low debt to income ratio. Assets, were there, income was there, low DTI, but just something as simple as trying to get some more information because they had a solar lease, right? And sometimes dealing with these third party companies can be quite difficult and can really derail a transaction where I would have said this probably would have closed, a week or two ahead of schedule. And ultimately, just because some delays that we experienced with the solar company.
yeah,
We were unfortunately a couple days behind the
yeah,
eight ball.
yeah,
We were able to get it wrapped up and everything. But yeah, that just kind of a blemish on that transaction ultimately.
yeah, yeah,
Kind of a little bit out of our hands, and I'm sure going back, there's some things we probably could have done differently.
yeah,
And we'll explore that. But yeah, with underwriting, I just want to say, every file is subject to the same underwriting guidelines for the most part. It's really dependent upon your loan program and everything like that,
yeah, yeah,
So, just some tips if I can, for anybody that's looking at buying a house or refinancing, just some things to keep in mind, just always be open and transparent with your loan team. You know what I mean? We're
yeah,
there to bat for you.
yeah,
If there's something that, you're not sure about, speak to Mike or myself or, whoever you might be working with. You know what
yeah,
I mean? It
yeah.
makes it a lot easier rather than it coming up down the line.
100%, dude. 100%.
Because we've had that happen before where, there's something where someone maybe thinks like, hey, this probably, won't come up, or this is a minuscule detail of my transaction, but underwriters review things with a fine tooth comb ultimately. I was honestly shocked at the level of analysis that underwriters input when they review a file.
Yeah.
And that's why, too, whenever you do see that underwriting might be taking a little longer than anticipated, shout out to our underwriters. They do a lot of work,
Yeah. Yeah.
basically reviewing every aspect of a transaction and a borrower's application.
What's the funniest thing in the world, I think, is, I've been with American Pacific Mortgage now 15 years, and 8 of those years we've been ranked in the top 1%. We've hit Scotsman Guide and Mortgage Executive Magazine's top 1% of the nation, and we continue to do incredibly well, and we just
Mhm.
continue to thrive. And, I get recruited a lot. I get a lot of calls. In fact, some of those recruiters may listen to this call and hi, everybody. But they're all trying to pick us up, Joe. They're like, dude, why don't you come work here? And we have friends that worked at our company that I've known for years, decades, and they were with APM for 10 years or so, and they decided to make a move. And I'll say this about American Pacific Mortgage and Ned, Sean, if you guys hear this, this is for you. There is no better company. There's no better family, no better Ohana. I am so blessed to be a part of this company. I've been with this company for 15 years, and I'm going to stay here. And the grass is greener where you water it. But I will say this about our underwriters. We have a team that is incredible. They're responsive. They get to us. We can work through scenarios. We can broker transactions. In fact, there's been those circumstances where we didn't have the best pricing, candidly, right? As a company, we brokered it in order to get the best pricing. Because at the end of the day, that's what we're here to do. Bless our clients, get them the best thing we can, take care of them, and hook them up. And as we did this, we're looking at us like, man, these underwriters are pain in the what. We have a transaction right now. We're going back and forth. We want to price it between various loans to value. We have to email them to give us pricing as to where we could jump into our system internally and just do it automatically. And it
Right.
happens within a few minutes. I can put together a full email draft explaining all those benefits for each individual transaction so they could, of course, come up to their best solution. And American Pacific Mortgage, our underwriters, tap the hit to you guys, or tap the hat to you guys. Tip the hat. Sorry,
Tip the hat.
not
There we
enough.
go.
Tip the yeah, not enough coffee today, man. But
Sorry, it's a tongue twister.
dude, it's a 1 year old and a 2 year old in my life, man. What do you expect? But that said, just blessed. I mean, I can't say that enough. So, I want to share some graphs that said, and, just say, we are with a great company. Underwriting requirements are the same for everybody. I don't care what your net worth is. I'm not going to talk about my net worth, but I do fairly well. They're going to give me the same guidelines that anybody else. If I'm showing losses with my 8 or 9 rental properties, then they're going to show losses that say, okay, well, this is a tight debt to income ratio. If I have a better debt to income ratio, great. If I have solar and the solar company is not performing, and we often run into this with solar companies, it's to delay your transaction. The best thing you can do is just be a team player to work with your loan officer, whether it be our team or anybody else, and try to get those things done. But I want to point out a couple of graphs, and I'm going to steal this from my friend Josh Metal and Loan Atlas, because I like this graph. And also, I'm going to share one first, perhaps. I think I'll share the first one real quick. Let's do this one. This is from Mike Lyons, who's an agent in Southern California. Mike and Allie, great agents. I even commented here sharing this on my podcast today. Here's evidence, Mike, Allie. If you check this out, a stock market drop doesn't mean falling home prices. Here's the Standard & Poor Index S&P 500 compared to home prices, and this is showing through these recessions we had. This is 80. This is essentially when we had hyperinflation at the end of the Carter administration, right? Home prices, of course, in blue, 7.2%. We had a nearly 20% drop then. And then, of course, as we came into the savings and loan crisis, this was a big drop in 87. This is 25.5 versus just a 1.7, right? Here. And this is a savings and loan crisis that led into the early 90s. We did see some buyer activity. We did see appreciation take place then. Of course, we had, .com in that era, 43% drop then in S&P, right? What a market that was. A lot of us do remember that quite well. Again, if I were to say one thing, people are thinking politically minded these days. This really is not necessarily politically minded. We did have, in this area, we had Carter, we had Reagan here, we had this tail end of Clinton going into George W. We did then, of course, this is the second term of George W. This is the Great Recession of 2008. And of course, we did have the COVID era, which was the Trump administration. And of course, throughout their former administration in 21, 22, we have a 20% drop then, though, and people forget about that. Now, if we look at the stock index, today and where we are, things aren't too far off. And of course, we are seeing continuous appreciation. We're seeing a little bit more of a concern, I think, with home buyers in regards to what they're doing right now. And I think that's funny. I think it's one of those peculiar things where they're concerned about a recession, but what they don't understand is recessions, of course, bring usually lower interest rates. So we're going to show this comes from data from Freddie Mac. This is, of course, Josh Meadows' presentation. So, Josh, if you watch this, I'm stealing it from you, buddy. But if you look at this, we see really where rates dropped. And of course, those same years, 80, right? We saw, I think Volcker was the Fed chair then. We saw, this 18% to 13% in 82. During savings and loan, we saw 11 to 8.75. I remember my uncle boasting about that 8.75 or 8.5% interest rate he got. Remember this in, of course, after .com, 7.3 to 6.75. After COVID, or not COVID, pardon, the Great Recession, 6 to 4.875. And of course, COVID, which lasted longer than I think it should have. And that's probably why we had hyper appreciation in market cycles, right? Where we saw over appreciation in some areas. And of course, we're getting corrections of that. So certain markets in the country, here in California, those major metro areas, we are, still doing fairly well. Now, I want to show, of course, this slide, which is where most people are concerned. Housing prices are going to drop. It's going to be 2008 all over again. And you're watching conspiracy stuff. And I don't know, man. I mean, there's a war going under the White House, 3,000 feet, and it's this and that, and lizard people. I mean,
Lizards, yep. I was about to say the lizards are implemented in the system. Absolutely.
bro, no. So check this out. Housing prices have gone up in 5 of the last 6 recessions. The one it didn't, you guessed it, we talked about it earlier, 2008, 2009, right? So this is what we're seeing. We saw a huge peak in here. What people don't understand is home building. I think we have this graph in here. Did Josh, wish I had him so I could ask him, bro, did you include this? So yeah, we said number of homes on the market. This is supply and demand. There's
Yeah.
another graph, and I got to pull it up. Maybe we can pull it up next time. But the amount of houses that they built are far less than what they've built in previous markets, and that was after 2008. Of course, the builders' confidence and sentiment a little bit lower, and as a result, we're seeing less properties. So what we are seeing at the same time, this is from MBS Highway, Barry Habib. We're starting to see household formations higher. We have a delta of about 4 million houses to meet the demand for housing in this country. So I don't care where interest rates are going to be. Home prices likely are to continue either flatten in some markets or continue to appreciate, which is why we might not get 10, 15, 30 offers. We had 58 offers on a property in 2021, and it was a condo. I remember my buddy who was listing it, they had a line out the door, down the stairs, around the corner, out the other side. And that was then. Now, maybe not. Condos are harder to finance, and we'll get to that. But it's one of those markets where it's a little bit more of a difficult market. And I think people are just need to be aware of what we're seeing in the market. The second interest rates dropped to 5 or 6%. Those who are still looking or they're up on the fence, they're going to come back into that market and they're going to rush this market. And it's just a fact. And it's
Yeah.
because of affordability. It's because they know homes will continue to appreciate and they know that they still have a dream of owning their own home one day, not dealing with a landlord and rent that continues to rise or raise their prices year over year, right? And that could be 8 to 10% depending on the market you're in. If you're in a rent control area, of course that could be different, but in California, in most areas where they have rent control, the newer rent control laws are usually whatever it is, 5% plus whatever that current inflationary figure is, right? So right now, let's say inflation's 2.4 or is your CPI. So if you're 5 plus that, it's 7.5. If you're paying 3,000 a month, do the quick math there. Let me see, 3,000 times 7.4. It's another $220 a month. So it's $3,200 a month, right? So that's what you could be spending another year from now. You compound that over time that rather than just purchasing a home, still makes sense to buy. Plus, you're developing equity. And we're dealing with appreciation in California, 8 to 10%. It's flattening a little bit right now, but use the year over year. Remember, right now is not just forever. It can last a longer period of time, right? You want to compound that over time. You have we say for what we do in our industry, 90 days, but really you're looking at a 3-year rule. Where is that appreciation over the course of 3 years? and the longer, of course. And we use that. That's one of the presentations we use when we talk to our clients. If you're to purchase this property at X price, what does that look like 5, 10, 15 years from now in regards to appreciation and how much wealth you're able to develop for your own family, your family's future, and so forth, right? Um, that said, condos, Joe, what are we seeing with condos, man? Let's talk
I,
about condos.
we're seeing a shift from condos and more of a shift towards TICs or tenancy in common. And this is definitely something we're seeing more out of Los Angeles County. I think we've only seen maybe one so far in San Francisco. I know we've done a few in the past, but as of late,
Yeah,
it's much more prominent in the LA area. But yeah, I mean, with condos for the most part, like you mentioned, they're definitely become a little more harder or more difficult to finance within the last year,
yeah,
ever since the incident in Surfside in Miami a couple of years ago. So we're just the condo review process has become even more stringent than it already was.
yeah,
On top of that, you're dealing with similar to like the solar situation where you're dealing with a third party to the transaction. So I mean, not that they don't have an interest in it, but they don't really have an interest in your particular transaction. You know what I mean?
yeah,
So
yeah.
you are abiding by their wait times. So if you have a very short close of escrow, we're ordering things from the get-go and we're still seeing, almost 2 to 4 weeks to get some documentation unless you submit a rush request fee, which can be anywhere from, $100 to $200 to $300 just to rush a document.
Yeah,
So that we
just get
might
a
need.
single page of paper. It could cost
Yeah,
$700,
right. And you
folks.
can't go directly to the HOA. You have to handle it with their management company
Right?
that oversees the HOA's documentation and everything like that. So it can definitely offer some obstacles when purchasing a condo. So that's where you want to work with your realtor and your loan team. Um, to try to maybe see when you're buying a condo, maybe get in front of that, see what you're getting into, really, really do your research with your realtor,
Yeah.
and see how many properties or units out of that condo have been sold previously. So you can kind of know, like Mike was saying, if you're looking at a long-term investment, what's the likelihood that you're going to have issues selling in the future?
Huge,
Yeah. So
huge,
that, huge, very
huge,
huge.
very
But
huge.
I mean, but at the end of the day, we're still able to make it work. We have tons of other options, companies that we can broker out to. And we've had to do that before where we can't underwrite a condo in-house.
Hmm.
And then we take it to someone else and, we're able to get it done there. But um, definitely it's caused some obstacles, some sleepless nights, right? Trying to figure out how we're going to get it done. But more often than
I
not,
have a 1-year-old and 2-year-old. My sleepless nights are for different reasons.
that's just added on top of it, right?
Yeah,
Yeah.
dude. I heard my
So
youngest screaming. I'm like, what? And she's like, passy. I'm like, "Oh, you just dropped your passy. You have like 12 of them in there, right? So,
our house is like literally there's like little stashes, like little pockets of
yep,
passies throughout the house. Like we're trying to my son Cam, he's 21 months. He's still not quite where he needs to be speaking. And we're trying to, we're taking him to speech therapy and everything like that, trying to get him more, fluent. And
yeah.
they told us, try to keep the passy away from his mouth. So we keep the passy away, and the next thing you know, he's finding another passy somewhere. First, we're just like, ew, where'd you find that?
Bro, they
But
hide them. They hide them. Trust me.
exactly,
I
yeah,
mean, I
yeah.
was cleaning out my truck the other day and I was like, dude, what? And I'm like, passy, 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 passy. And it's like, I'm like, oh my goodness, Lily, what are you doing? But it's fun father stuff, right? I mean, it's yeah, and I know like talking is a big thing. Passy, we should get Jacqueline on here to talk about the dental implications of and what it does to your
Oh
palate
yeah.
and your mouth and your jaw and all that with pacifier. Amelia is going to turn 3 and we're doing everything we can. We her off. In fact, I had ChatGPT help me with that. I kid you not, ChatGPT wrote me a children's book. So I can share that if you guys want the link. I'll print it out and it's free. But it's funny, man. It's one of those things. But back to the market stuff with the TICs, what happened in Los Angeles is affordability changed things. And it's cheaper to form a tenants in common type property than it is going through the whole legal process, I think, for a lot of folks, developers, builders, those looking to flip properties than it would to do a condo. So, TICs have always been a huge thing in San Francisco for years. Didn't investigate much on it. Kicking myself when I found out and candidly was like, man, let's just learn and get this as a niche product. And we do a lot of TICs now.
Yeah.
We probably get 4 to 5 applicants a week that are just doing TICs or, from TIC developers throughout the Los Angeles area because now Los Angeles, they're catching up to what had taken place in San Francisco and we're doing TICs. In a lot of ways, they're easier than condos. Condos,
Yeah.
we had Senate Bill 326. And what it usually that is, everybody wonders what this is. And I had a call with an agent who was my former agent 20 some odd years ago when I bought my first property. And she's like, somebody told me that this condo is on the Fannie Mae blacklist. And I'm like, what? And I'm like, I knew what that was because a lot of people are using that term. The actual term is non-warrantable condo. What does that mean? Well, what's going on is Senate Bill 326 came out and it's basically improvements to the property to make sure it's just not a safety hazard to an individual occupying the common area of a property or could be, essentially hindered by the common area of a property when they're trying to escape their property in a natural disaster. What this comes from is back in 2020 in Florida, we had two condos, which was a tragic event. Most people know about it. If not, look it up. But the whole thing shifted and it became a Senate bill now. If you're going to occupy or acquire a condo, it's required that it passes the SB 326 report and permit process. And what that essentially means is you're going to be okay if fire hits the building or a natural disaster, an act of God of sorts. And so that idea now is like, oh my gosh, what if it's not? And so there are folks that said, okay, let's just try to get an exception on this. Other lenders, perhaps, they'll send it to Fannie Mae for that exception for what we call a PERS exception, PERS. And as they send that out, Fannie Mae reviews it like, oh, nope, you're good. Sorry. They won't lend on it. So the question then begs is, can you do a loan on a non-warrantable condo, even if it didn't have SB 326 completed? And the answer to that is yes, there are institutions that will do what we call non-warrantable condos. Pricing may not be as favorable. You might not get down payment assistance. You definitely won't go FHA or VA. By the way, VA requires its own approval. FHA again allows for a spot approval. But you can look at these particular condos, or you can perhaps broker to what we call a non-qualified mortgage company. And non-qualified means it's not like subprime 2008 as I was showing in the graph earlier. It's essentially non-traditional home loan based by Fannie Mae, Freddie Mac. So what we call the GSEs, the government sponsored entities or a conventional guideline. And pricing is still, they're reviewing documentation, credit, asset. They're still doing a full underwrite. However, when it comes to the condo, as long as it meets certain criteria set by that individual non-QM lender, it still may pass. So you still may be able to get a loan on that transaction. And a lot of folks don't get that. Again, not VA, because VA is very strict. Not FHA, still pretty strict. Not conventional. Fannie Mae, Freddie Mac, they're out. But if you look towards a non-qualified mortgage, you may be able to get away with a 10% down transaction. And here's the cool thing. If you're self-employed, there are alternate forms of income. Subprime again, no, not subprime, but it could be bank statement loans, verifying deposits with a bank statement transaction showing 12 months or 24 months of your bank statements to show you've been producing income or having deposits. Then a profit and loss statement, right? So there's profit and loss loans as well. There are other things that can be done with these particular programs. They're incredibly helpful for a lot of folks that are like, hey, I'm self-employed, but I do X, Y, or Z on my taxes for whatever reason. We're not here judging either of those reasons or any of the reasons, should I say. But there are ways to get into these non-QM properties. But as said, Joe mentioned, we're seeing less properties that are condos. We're seeing more TICs increase at the same time. And with the non-warrantables, we're seeing more properties on the market, staying on the market for X number of days, meaning we're starting to see more price reductions with the condo market because it's getting more and more difficult to finance a condo, which is very interesting. I mean, we're seeing that, of course, that's, I think, the big dip. So if you look at that, you look at the mix of 1% to 2% of basically depreciation rather than appreciation, count that in the mix, put that in the blender, right? It's going to kind of, a little leaven could leaven the entire loaf, as they say. So you're starting to see more things shift our market as a result. And we're starting to see some of that. And I think that's the big thing a lot of folks have to look at when you look at that figure. How much of that is a condo market? What does that look like? What are you seeing in condos in your particular market area? Those are all important things I think to take a peek at.
Absolutely. Yeah. Just make sure to, reach out to your partners if you have any questions or,
Yeah,
do some research initially and especially
100%.
when you're looking at a condo versus a traditional single family residence or anything like that. So,
Any questions, we're here. I mean, hit us up. I mean, our links are here. Just shoot me a message. Hey, Mike, what do you think about this? I'm happy to help. That's where we're here. We're here to be a resource, right? So, anything as we look at today's Fed day, we're all concerned. I know news today had U.S. talks with China. We haven't looked at that yet, candidly. I've been watching bonds this morning, but not a big shift from where we were yesterday. We're looking at the 10-year Treasury about where it is yesterday. It's pretty much flat. And same thing with our mortgage-backed securities. So really nothing with rates, but as we go into this week, we're still watching things, I think, and we're still somewhat hopeful as it is a new month. But who knows? I mean, it's this and that. It's a giant pendulum. But any thoughts that you have, Joe, before you head out?
yeah, no, I mean, all I'll just say is we're hopeful that things do improve in the near future. We don't have a crystal ball, obviously.
Yeah.
But like you said, we're in a new month. We're approaching this month positively.
Mhm.
We've had a pretty solid April. Had a lot of clients that we were able to help get into new homes. Still working some refinances, which is just crazy from a couple years ago when refinances just weren't a thing. You know what I
Yeah.
mean?
Yeah.
Right after COVID, or after that refinance boom in 2020,
Yeah.
2021, we had a little bit of a lull there. So for someone who's only been doing this for 6 years, and I keep constantly being told like this is completely different than what I'm used to, or this is unprecedented in the industry. So it's just always a learning experience for me. So,
Yeah.
but yeah, we'll go ahead and attack May, and yeah, hope for some improvements.
Dude, always. I mean, here's the one thing. Slow Song goes back. Slow Song. It's always
Exactly.
this movement, right? So it's like it's a staircase. You take a step, you're on that step, okay. You level out for a second, maybe take a step back because you lost your footing, but then you go up two more steps and it continues
Right.
over time, right? And it may be quick, it may be slow, but one way or another, it's continuous. And that's what a lot of folks I think need to realize. And that's a good point there. And yeah, I can't believe, I mean, how vast Joe is in his knowledge, folks. You've grown, and it's cool to see,
Oh,
man. Since
thanks, man.
when you picked up that gosh, around the 4th of July, 6 years, 5 years.
Is it 5 years? Okay, 5 years.
5 years,
Yeah,
5 years, 5 years. But we'll say six. You're going on six after July, so that'll work.
sure. Yeah, let's do it.
For sure, man. All right. Anybody questions? Anything else? If you guys want copies of the graphs or anything I shared, shoot me a message. Happy to do that. But here's to May, a great month. And yeah, next time we're gonna have a guest talking about their particular market, talking about what they're seeing. I believe in the East Bay, and be able to unpack that. So be on the lookout for that. Until next time, see ya.
Take care.